going to do now is I'm going to bring up part of our USA team. They're dancing in the background. So, Ben, you need to come around here, honey. I'm going to bring a guy up on stage. Now, his name is Ben Walls, and he is our 21st century US property acquisition team. So his role is actually, he lives in the US, and he'll talk to you about what he does. And for us, at 21st century, we need to be comfortable that we've got somebody looking after our stuff, right? So we've flown him in. He's they're both dedicated. I'm going to bring, firstly, Ben up, and then I'm going to bring up our property manager. She's so gorgeous. You're going to love her. And I think you'll like Ben too, because it's a bit of a Ben and Barbie team. So if I can just bring Ben to the stage, give him a nice Aussie welcome, Mr. Ben Walls. Look at him. Hey, is he lovely? Hey, Ben. Thanks for coming.
Thank you. Thanks for having me. All right. Wow. All of a sudden, it's a much bigger now that I'm here on stage.
I know. It's a really, really big stage, isn't it? So I could be right over here.
It's big. You seem like you're far away from me.
No, I'm close, baby, so that's all right. So what we're going to do is we're going to just ask Ben some questions that we know that you've already asked. So firstly, Ben, can you just tell us what your role is with 21st Century over in the US?
Well, what I do primarily, as she mentioned, I'm part of the acquisition team there. So what we do is we go out, we have some selected cities that we'll talk about. We focus on these cities for specific reasons, and what we do is we go in, buy the properties, do the rehab, place the tenants, place the management company. Once it's packaged as a turnkey, done-for-you investment, we then sell it to investors. So that's basically the long and short of what I do is I help package that product from the raw product to the turnkey, finished, cash-flowing product, and then deliver it to our investors.
So what selection criteria do you go through about purchasing which properties to purchase for our clients?
Well, the one thing we want to always do is we want to stay in a high demand for tenants. So we always want to stay in areas where are very livable and where there's high demand for people that want to live there. And each city is a little bit different on where we're at in each city. The price points are different in each city. The reason for you to even invest in one city or another, that's a different reason as well. So as far as the product though, the product always has to be in an area that's going to be a high tenant demand and even where high owner occupants are going to be. So one of the things that we look for is to be in the areas where we're starting to see more owner occupants filling the occupancy as well. So there's certain areas of every city where it's nothing but renters. A lot of it is just subsidized, and the only people that live there are people that are renting there. We really don't like to be in those areas, although those areas are oftentimes cheaper. It's a lower price point to get into, but the problem we find is that it limits your exit strategy, okay? One of the things you may eventually want to do is sell. Well, you're not going to sell to a renter. So you want to be in an area where there is some rental demand, but there's also owner occupants as well. We're actually starting to see a lot more owner occupants start to buy, even in today's market where it's harder to get loans. We're starting to see in some of our markets where owner occupants are starting to buy more. So it's a very good sign for us.
So I might just interject there for a minute. Can we just move over to here because it just triggered something. I'll just move this chair out of the way. Yeah. So what we failed to mention before, do you want to swap sides because I'm right-handed? Do you want to stand on that side?
Sure.
Thanks. Can you guys see that? Okay, cool. Now, there's 4 categories of properties that we usually look into getting, right? So one, Ben, is the ones we don't touch, right?
That's right.
So can you explain, well, firstly we'll do the 1, 2, 3, 4 categories. So the ones we don't touch. The next one is the capital growth strategies category. Capital growth. Boom, right? The next one is what? Cash flow.
High yield. Mm-hmm.
Who likes cash flow? Scream. Woo! Okay, and what about both? A bit about both.
Got the hybrid.
So these are the 4 categories, guys, that we are looking for and that we get Ben's team to research and go through. So can you just explain to us about the first category of properties that we don't touch and why we wouldn't, and those places?
Sure, the don't touch categories, there's certain cities in America that I think you can go in and you can see online. You guys have internet access and Google just like everyone else. You can see some of the cheap prices, $10,000 for a house. I'll throw out Detroit just for an example of really cheap city to buy in. You don't want to get confused just because the price point is cheap. You always want to look at sort of the long term and see, where is it in the city that I'm buying? What is the city that I'm buying into? What is the economic factors that make up this city? One thing to realize is that the U.S. is a very large country, a lot of people in it. There's almost small economic regional demographics rather than just one large country. What's the country doing? Yes, but what is each regional area doing, and how can I maximize my investments by going into the right areas? So there's several cities that we don't mess with, even though they have a lot of notoriety, a lot of media attention.
Such as?
Detroit would be one.
Detroit.
The Florida market, a lot of
people. So these, where not to buy, right? Don't buy in Detroit.
Yeah, not a good idea.
So what, you need a flak jacket and
we don't believe
helmet
in it.
To go?
Yeah, right. You need to go in full SWAT gear. We don't believe in that city because we don't think the economic factors, the fundamentals support good long-term growth. So bottom line. There's a few others. The California market, we're not quite sold on California yet. We think that California is going to be a good market eventually, but we're not quite there. Florida is another market that seems to get a lot of hype and sort of media attention.
So these are the ones that he's mentioning now. It's not that we're not going to go there. They're just pending, right? So you put them in your pending tray because we're going to potentially look at these later, right? In the next, what?
Oh, absolutely.
Depending on the economy.
There's going to be a time to go into some of these don't-touch markets, and I'm going to say Detroit, probably not going to be a time for that anytime soon. But like some of the markets like Florida, they're still seeing values go down. We don't want to go into Florida just yet. We want to kind of hit that as we start to see values come back up. So certain cities that we've narrowed down for the reasons of, again, underlying fundamental factors, the local economies that support it, and the outlook of what it is we're looking for the investment, either high yields or high capital growth potential, or sort of a mix of both. And we'll go into some of those cities here in a minute.
Okay, so next category is the capital growth. So just quickly give us those ones that we're going through.
Capital growth. I'll just go through the cities here.
Yeah, if you like. I'll just move this chair out of the way.
The capital growth city that we prefer, we did, sorry, Lou?
I just bought these, And look how tall. If you trip me up,
I'm scuffing her shoes. I'm going to owe her some money here. The capital growth city that we prefer, we've done some research. We felt like Phoenix, Arizona was the best market for future capital growth. Phoenix is one of the most livable areas of the country. All things being said, Americans would like to live in climates like the Southwest United States. It's dry. A lot of people move there just for health reasons alone. But Phoenix, the values were skyrocketing back in the rise. 05, 06, 07, values were going up tremendously. It got hit pretty hard. Values that got cut into thirds, sometimes less than a third. So, but we looked at Phoenix, we looked at the demographics, we looked at the fundamentals that make up the local economy, as well as the population that really hadn't decreased much, so we felt comfortable with that. So a lot of things that went into that decision to go into Phoenix and start putting a lot of our money in Phoenix. One thing that I guess I will mention that some people may take for granted or not think about is what we do as investors. We're cash buyer investors ourselves. And so every house that we go into, we own every property. We don't just go broker deals or find some house and kind of just say it's ours and move it along. We buy every house ourselves, and so in doing that, we have to make a very conscious decision of where we're going to buy and what houses we're going to buy and then what city. So it's a very calculated approach. We don't just shoot from the hip at all. There's just too much money at stake. You just can't make the mistakes when you're dealing with hundreds of thousands of dollars dumping into a market and doing what we do. So Phoenix
so if I could just put oh, you have already. So this is, as I said, if you take mental note or write the fact that the reason the selection of Phoenix is a high capital growth. So who in the room wants investment properties, regardless of where they are, to have a level of high capital growth? Hands up. Okay, who in the room are the cash flow people who prefer to have not as high capital growth, but prefer the cash flow, right? So or who would like both? A good mix of both. So if you look at these returns, between 8 and 10%, so the capital growth isn't as high as what we're about to show you in some places. However, who would be keen on getting a house for around 70 grand? Anyone? $70,000? That's the stamp duty here, right? It's a no-brainer. Now look, these properties we've taken about 3 or 4 different groups over to Phoenix, you know, in our US tours. We go over on a big 8-day tour. We travel around 3 different cities, Phoenix being one of them. And even our members that purchased recently, January tour and the second tour, that bought houses on average around $60,000, $70,000, have now already gone up to around $90,000. Is that correct?
Yeah.
Yeah.
Mm-hmm.
Okay, so let's move on to the next category, which is category 3. Oh, so that's, just so you know, that's where Phoenix is located. Okay, Phoenix, Arizona, fastest growing, offering high return, and that's what you're looking at, capital growth. So that's where we're going to choose, because surely I'm going to bring up one of the property managers that is located there, and she's the girl that looks after the properties for those people who choose to select them. So the next one is the cash flow, Kansas, Ben.
Kansas City, yeah, Kansas City. We like Kansas City a lot. Kansas City is one of the most stable cities. It's a Midwest city. It's relatively small. It's about 2 million people as compared to some of the larger U.S. cities. Very stable, great economy, always lower than average unemployment. And the nice thing about Kansas City is that the price points versus the rents allow you to have just huge yield numbers, up to 20% net sometimes that we're seeing in Kansas City. The price points are, again, like you see here, from 30,000, kind of the starting, up to about, say, 50 to 60,000 is kind of the max that we're seeing in Kansas City right now. And that's going to bring you a rent of, you know, 600 to 900 per month, just depending on the size of the property. So Kansas City is one of our very preferred markets for high yields, for high cash flow yields. Now, Kansas City is not a high capital growth market. You're going to see, you know, very little to moderate appreciation over the long term. You might think 2 to 3% as things are going along as normal. So not a high capital growth market, but a very high yield market. So if your goal is to get high cash flow and get as much money as possible off that investment, then you're going to want to look at Kansas City for that.
Hands up who likes the high returns of around 18, 20%. Anybody here? A couple of you, excellent. Right, so what about the next one? Oh, that's where Kansas is. Is that where Dorothy and Toto come from, right?
What's
no
that?
place like home?
No place like home. Now, I don't have my red slippers on here, but and I've tried that before. It doesn't work.
It doesn't work in the US. It works here. Okay, so the next one, Atlanta, Georgia.
Okay.
So this is more the category 4, correct?
That's right.
So you got a bit of both.
That's
so
right.
You got a bit of capital,
Now,
a bit of cash flow.
This is what we call our hybrid market. The reason we call it a hybrid market.
What is it called?
Hybrid, sort of a mix.
This is your accent.
Yeah. Is
You
that?
got to speak a little bit slower.
How do you say hybrid?
Hybrid.
Hybrid. Okay. Did everybody get that? So that's our mixed market. That's it's the market that has pretty good capital growth potential. It also has pretty good cash flow returns at the same time. The reason that we're in that, we looked around. A lot of our clients came and said, "Listen, I'm not really sold so much on high capital growth. I'm not really sold so much on high yields. I kind of don't even really know what I want. Maybe I want a little bit of both. Do you have a good market that's solid that we can invest in that's got a little bit of both?" And so we looked around, did our homework. We fell into Atlanta, Georgia. Atlanta, Georgia, here again, it's in the southeast. The Atlanta, Georgia, the local economy there is one of the largest economies in the country there. It's got 5 million people approximately. Many Fortune 500 companies are headquartered there, so very good market to do. Again, not quite the yields as Kansas City market, and not quite the future growth we believe is the Phoenix market, but it's a pretty good hybrid model, pretty good mixed city for a little bit of both.
So when you're looking at balancing your portfolio, as Jamie's mentioned over the weekend, you know, if it is capital growth that you want to go for, then you target those areas. And obviously, we've got different other areas that our team and Ben's team in the US are actually doing the due diligence on. So, you know, you've got 2 options. You can go and do all this stuff yourself, right? But who here in the room is time poor? Anybody? Right? So the time poor, I'm the time poor girl, right? Plus, who in the room is lazy? Who just can't be bothered doing certain things and likes to automate their life as much as possible? That's me, because I want to get the result. I want to get to A to B as fast as possible. I don't want to have to do stuff, but I have to heavily rely on people, good people on the ground, to actually do that for me, right? I do that with my current businesses. I do it with some of my trading activities, and now I also do it with this. And so I'm happy to put my investments in the hands of somebody else, which is Ben. So you know, if you wanted to do the cash flow strategy and you wanted that anywhere between 15 to 20% return, you know, you're looking at houses around 30, 40, 50,000 in those areas. So imagine just going and having, you know, some of you are in a position to actually jump on these. Some of you need a little bit of finance or whatever it is, and you go and sort that for yourself. But opportunities, like Jamie said, of this caliber in the US, and as Harry and everybody else has said about the credit crisis, this happens once in 100 years, right? And if you don't position yourself ready to take advantage of this, did you hear that? What's that the sound of? What's that the sound of? Opportunity knocking. And if you don't do this, hello, you know, how many opportunities do you miss? You know, if you go, oh, 10 years ago I didn't buy this, oh God, I would have loved to have bought in Williamstown. I would have loved to have bought in St Kilda. I would have loved to have bought in Brighton. I would have loved to have bought in, you know, Perth, whatever it is. The only reason I made $1 million from a good investment in Perth is because the mining boom. You know, Jamie helped me negotiate that property. I bought it I got someone to negotiate it from 700 to 600,000, right? And then I sold it last year for 1.6 million. And the only reason I had that is because I had belief and faith that it would rise in capital growth. I looked at the market, what was going on, and I actually was a little bit brave and I went for it. Was it scary? Of course. Is it scary investing somewhere else like the US? Of course. But if you don't have a go, you'll never have a go, and then you'll just be boring. And no one in this room is boring, are they? You are all high achievers. That's why you're here. That's why you've offered and committed your Saturday to being here. So give yourself a round of applause. Okay, Ben. So we're gonna just churn through these now.
Yeah.
Okay, so what we're going to do now is Ben's just going to quickly just show you some of the properties that have recently sold in these three areas. So what I want you guys to focus on is the price, right, and also the net yield, which is down the bottom. Okay, go for it, Ben.
Okay, so here we go. This is Hearn. This is in El Mirage, which is a suburb of Phoenix. This property here sold for $89,000, $800 a month rent. It's 3-bedroom, 2-bath. This property was selling for well above $200 at the peak, and this is in an area where it was dominated by owner-occupants at one time. Now, many of those owner-occupants have now become renters, but they still prefer to live in quality homes in good areas like this. So this is it's kind of one of the properties, one of the models that we focus in Phoenix is actually that newer home, one that was built sort of in the last 10 or 15 years. And in areas where primarily owner-occupants were living and buying and now could still continue to live. Because when everything comes back and the owners start buying again, they're going to be buying in these neighborhoods first.
Yeah, and that's a good point. The banks will lend again. People will go back and buy their houses again. The thing is, you know, you can't use the excuse, oh, like I feel really sorry and it's really sad how it is. It is what it is, right? And you know, for a $90,000 house that's getting 9%, that's a good deal. Mm-hmm. So let's have a look at the next one. So 75 grand for this one.
Catalina, very similar situation. The yield's a little bit higher. The price point came in a little bit lower here on this one. Again, this one was selling back above 200 back in the high times, and the rent came in at 845 here. This one's a little bit bigger property than the other one. And we just got into it for a little bit better deal, and so we were able to sell it for a better price. But this one is also a very good property, great area. Here's one in Kansas City, Missouri. If you'll look at the net yields from the previous one, the net yield just jumped up to a little over 16 here. This was a sales price right around $50,000, and this is just a great little property. One thing I do want to mention on our properties real quick is that we don't just go buy in and slap stuff together to try to pass it off and just get a tenant in there as fast as we possibly can. One of the things that I mentioned, that it's all our property, it's all our cash first. We don't take loans of any kind in our business. And so one thing we have to be very careful of is going into every deal knowing, or thinking at least, that we'll hold this asset long term. Yes, we're in the process of buying and selling, but eventually if nobody sells, our worst case hedge is that we're holding this property for the long term. In that, we have to make sure it's a quality property, we've got good tenants, good areas, all of those things. So if it's in my portfolio, you better believe I want it to be a good house.
So we've got Atlanta.
This one here, Lindsay Drive in Decatur. This is in just outside of Atlanta, Georgia. This is a suburb of Atlanta. This is an example of sort of our hybrid model. You can see the returns are sort of right in between the Kansas City and the Phoenix returns. This one's just right under 13% net. Here's another one in Atlanta. The returns again are right 12.5. I mean, we're typically going to see Atlanta returns about 11 to 14, 15% net. We can go on to the next one here.
So, well, they're the ones we've sold, and as I said, they offer, you know, our current members, they obviously get these properties probably last maybe 3 or 4 days, right, with our clients. So obviously the first in, best dress. So these are the latest ones. I just want you to whip through these really quickly, but as I said, guys, if you just have a look at the net returns, the price of what it was, and then I'm going to bring up Rihanna, who's our property girl, and we'll ask her a few questions.
Sounds
okay?
good. Sounds good.
So,
we'll
Phoenix, so we're back into category 2.
Yep, this is category 2. We're back in Phoenix, Arizona. Again, this is our high capital growth market. This is a good property here on Sonora, 3-bedroom, 2-bath. It's a family living in this property. Just a great property here. This one was built less than 15 years ago, and just a solid investment in a good area. Buckeye is one of our preferred suburbs, actually, right outside. It's on the west side of Phoenix.
Next one up.
Great
the
area
next
that
one
we
up.
like here. This one, Columbine Drive. The reason I'm chuckling, Columbine Drive is actually, when we bought this house, a lot of times we go in and we test the market. And when I say test the market, we buy houses for the idea to say, hey, I'm going to put this on the owner-occupant market. Because I want to test the owner-occupant market. That's the only way to test it, is to put some houses out there for sale to owners and to see what comes up. This was actually a property that we were planning to do that with. We had so much tenant interest in this property that we said, okay, fine, we'll take a tenant, we'll throw it into our turnkey cash flow model. So this one is actually, we're selling it at 100. This one will appraise all day long in the 120s, 130s, conservatively. So this one here, Linwood Drive, again, this is our hybrid model of Atlanta. Good returns and potential as well.
Who'd be happy with a house for 56,000 with a 14% net yield? Anybody? A couple of people? Excellent.
Now,
and this one, 53?
53, we've got, again, a 14% net here, just over 14%. You know, and we don't have the full photo reels on the PowerPoint, but if you were to see through this, I mean, you go through this thing, you're thinking, geez, $50,000 for a house. I know sometimes Australians, if you hear that for the first time, you guys are thinking, geez, what kind of neighborhoods are you buying in? What kind of shape are these houses? We could go through all these, and we'll have a breakout session. We'll have a little bit more time to do that. But again, these are all renovated. I mean, new everything: plumbing, HVAC, electrical, flooring, paint, inside and out, roofs. I mean, here's one in Kansas City, 46,000. It's got almost a 17% net yield. These are not atypical deals. We didn't just pull the best of the bunch for this event. This is what we do. These are the houses that we sell. I mean, this is sort of our bread and butter stuff. Now, you know, it did take a little bit of time to refine that. We had to, like anything, we had to do a little learning to where we got it refined. But this is what we do. It's not, for me. This is not. I don't have the wow factor anymore. This is just what we do. Again.
So we're not going to go through any more properties, but later on we've got a breakout session this afternoon where Ben and Rihanna will go into all of these in details, and you can ask any of your questions there and then. So what I want to do now is I actually want to, firstly, I want to bring up a beautiful girl. Her name's Rihanna King. You can see her there. She's gorgeous. She's the property manager, and she actually lives and resides in Phoenix, Arizona, right? So she's got 10 years experience, and she works with Ben. Ben finds the properties, and she makes sure that we have people, good people in those properties that actually are paying rent on time, right? So she's flown as well, you know, all the way from the US yesterday. I had to wake her up this morning because she was out of whack, out of time, both of them were. But please give her a nice, beautiful, warm Aussie welcome, Miss Rihanna King. Oh, welcome. Welcome.
Great.
Can you want to come
Great
over?
to be here in Australia. Hello, everyone.
Say hi, Rihanna. These guys are a little bit shy, so sometimes we have to prompt